Good morning, good evening, good afternoon, wherever you are in the world and you're watching this presentation. Welcome to this presentation about improving the productivity of people and equipment in the mining sector. While we are going to talk primarily about the mining sector, there are lessons here that can be learned in all industries, and I think some common themes that everyone can learn from. So even if you aren't directly involved in the mining sector, I would still encourage you to listen to this presentation. This presentation is I guess a slightly amended version of a presentation that I gave to the IMARC conference. That's the International Mining and Resources Conference that was held in Melbourne in late September in 2014. And so for those of you who were able to attend that presentation, hopefully this is a bit of a refresher. For those that you weren't, you haven't missed out. I'd like to talk about the past in terms of mining sector productivity, the recent past, what's been happening over the last 10 or so years. Talk about the current situation within the mining sector and what mining companies are doing to respond to that, and perhaps also discuss the appropriateness of that response. But more importantly, spend more time talking about the future and hopefully give some guides as to the key for possible future improvement in productivity of both equipment and people within the mining sector. So without any further ado, let's bash on. This chart shows the multi-factor productivity for the mining sector within Australia over the last 20 odd years since the late 1980s through to last year. And it's multi-factor productivity. We'll talk about what that actually means in a minute. But I guess what you can see from that, and there's a couple of different ways. These numbers are from the Australian Bureau of Statistics, and there are a couple of different ways that they can calculate multi-factor productivity. But regardless of whatever way you do calculate it, we can see that mining industry productivity in terms of multi-factor productivity has been falling since about 2001. And the interesting thing here is that actually predates the recent mining boom. So while a lot of, I guess, mining industry commentators have focused on the boom as being, and I guess the resulting actions as part of that boom as being potentially at the root of the productivity issues that are facing the mining sector in Australia, in reality, we saw the early signs of that decline before the boom really started in earnest. So I guess when you look at those numbers, what it says is that the mining sector in Australia clearly has a major issue on its hands in terms of productivity. And I guess potentially that is reflected in other mining industries around the world as well. In fact, a recent study done by PricewaterhouseCoopers has indicated that in fact mining productivity around the world has declined at a similar level, although Australia perhaps more than most. Australia now as a region rates only in front of Africa in terms of mining equipment productivity. Now when we talk about multi-factor productivity, what do we actually mean? And basically at its heart, productivity is simply I guess a calculation of outputs divided by inputs. And in terms of those inputs, the key aspects that go into measuring those inputs are a number of factors. K in that equation stands for capital, so that's I guess a figure for the use of capital. L stands for labour. Energy is used in some models, but not in others. M for materials and S for services. But when we look at the mining industry, and I guess this is true of all capital-intensive industries, what we find is that the capital component of those inputs is comparatively high. Mining is a very capital and equipment-intensive industry, and in comparison, labour is generally a lower figure in terms of input. And yet when we look at where the mining industry in Australia at least has been focusing its attention recently, it has largely been on the labour portion of that input. There's been a lot of I guess, so-called productivity improvement. They call it productivity improvement, but in reality, what they've been doing is indulging in headcount reduction. And I would argue that headcount reduction, while it may have a short-term impact on productivity, at least as it's measured by this formula, potentially has a longer-term detrimental effect on productivity, depending on where that labour comes from. And so I would argue that right now what the mining industry is focusing on, while they say they're focusing on productivity improvement, in fact they are focusing largely on cost reduction. And cost reduction is not the same as productivity improvement. Costs are primarily an output. They're a result of the things that you do. Productivity improvement, on the other hand, is an input into that productivity equation. They are the things that you do and the way that you do them. And so the cost reduction is not the same as productivity improvement. And while I guess some people, and it would seem at least, are arguing that cost reduction leads to productivity improvement, and it does clearly in the short term, I would argue very strongly that that's not the case. That in fact it's only by focusing on productivity improvement and in changing the things you do and the way that you go about doing them is what will lead to sustainable improvements in costs and reductions in costs, certainly unit costs within the mining sector. So one of the keys here is to perhaps ask ourselves the question, and we tend to think about labour productivity versus capital productivity. Is it an either or situation? Can do they have to focus on only one of these things? Is it possible, in fact, to achieve improvements in both capital productivity and labour productivity at the same time? And I would say very strongly that yes, you can. And we can do that largely by focusing on reliability improvement, improving the reliability of the equipment that you are operating within the mining sector or within any capital intensive industry. So let's examine that proposition in a little bit more detail. Now this is a fantastic chart, and I wish that I could claim that this chart was my own, but in fact it has its roots in work that a gentleman by the name of Winston Leday did when he was at DuPont Chemicals and Specialties, and in work that they did through the 1980s and 1990s. And we'll see a little later on in this presentation some of the results that they achieved. But what they managed to do over a 10-year period was to significantly improve the performance of their organisation, and in doing so across multiple plants, I guess came to the realisation that improvement happened, or each of those plants tended to stay in one of several domains. So let's examine this chart in a little bit more detail. I could talk for 20 or 30 minutes just on this chart, but for the sake of brevity in this presentation, I'll resist that temptation. At the extreme left-hand side of that chart, you can see the domain called Don't Fix It. Clearly not sustainable in the longer term, so we'll put that to one side for the time being. The next domain up from that is called the reactive domain, and the I guess focus of organisations and plants that operate in that domain is being one of fixing things after they break. It's about responding to breakdowns, and organisations can actually get very good and very efficient at responding to breakdowns. However, in most cases, organisations and plants realise that's a fairly high cost domain to operate in, and so with a focus on cost reduction, they tend to try and move more into the next domain, the so-called planned domain. And this is about trying to catch things before they break and fix them before they break. So putting in preventive maintenance programs, predictive maintenance programs, those sorts of things. Very strong focus on planning and scheduling. It's about having lots of rules and systems and procedures in place to make sure that work is properly identified and properly planned. And then beyond that, we move into the proactive domain, which is really about not just catching things before they break, but actually eliminating the things that cause them to fail in the first place. It's about, I guess, improving the reliability of the plant. And the theory at the time that this model was developed was that before you could move into that proactive domain, you needed to be solidly in the planned domain. You needed to have things in control and capable, to use that phrase, before you could start focusing on improvement. The reality of it is, and Winston Leday himself now recognises that, and in fact gave a presentation at an SMRP conference in the United States a few years back, where he now realises that in fact that planned domain is not a stable domain. That in fact the way to become a highly planned organisation is not to focus on trying to be more planned, it's by focusing on being more proactive. When you think about it, what is it that stops you from achieving high levels of planned work? It's generally the disruptions to your plan. It's the things that interrupt your plan, the breakdowns, the operational disruptions as well as equipment breakdowns that happen that prevent you from achieving high levels of planned work. And Winston came to this realisation after he'd spent some time at the Lima refinery, an oil refinery in Ohio in the United States. I guess fairly famous within the United States as being one of those refineries that's been on the verge of closing down many times. It's being seen as a high-cost refinery, been through multiple changes of ownership over recent years, but has so far managed to survive. And when Winston went there, they were achieving incredibly high percentages of planned work in terms of maintenance work. In the 90% of planned work. And when he asked them how they managed to achieve such high levels of planned work, their answer was that they achieved it not by focusing on trying to achieve high levels of planned work, but instead focusing on eliminating the things that caused breakdowns and that caused them not to achieve their plan. So if you try and focus only on being in this planned domain, the breakdowns will continually be pushing you back into that reactive domain. So really, what you need to do is to focus on being proactive. You certainly need a basic level of discipline to make sure that the planned work does get done, but at the same time you need to focus on eliminating the causes of failures. In other words, focus on improving reliability. And again, one of the things that we see at the moment within the mining sector, lots of the big mining organisations focusing very heavily on improving maintenance, tradespeople or craftspeople's tool time. And it's about improving, again, the focus is on improving planning and scheduling. But all of those efforts are destined to have limited effect if we don't actually at the same time focus on eliminating the things that are causing the disruptions to the plan. So I guess what the mining sector is, at least in our experience, is doing at the moment is necessary but not sufficient to improve productivity within the sector. The key, as I said, it really is to focus on reliability improving the reliability of the equipment, improving the reliability of your operation more generally. I guess when you look at that chart, where do you see the word maintenance on there? It's not on there as well. So the same concepts apply when you talk about operational disruptions, hang-ups in chutes or blasts that misfire and those sorts of things within the mining sector. So I guess what I'm saying is really we should be focusing on trying to be more proactive, focus on reliability improvement rather than focusing solely on trying to be more planned and in control. Focus on reliability rather than just focusing on maintenance labour productivity. So what are the keys to success? Obviously you can't focus on, or you can, but it would be an extremely difficult effort to try and focusing on improving the reliability of all your equipment at the same time. So what is really critical is focus. And so we need to focus on those critical assets or those critical asset systems that are, the most, that are going to give us biggest bang for buck. The ones that are the bottlenecks, the ones that are the high cost items, the ones that are basically causing you the greatest grief at the moment, that also create the biggest potential for upside for the whole organisation, not just for one part of the organisation. What I would suggest then is look at those assets and figure out whether they're actually fit for purpose, whether they're designed to do what you're now asking them to do, because if you're trying to run the equipment with a knob turned up to 11, you're bound to have reliability issues. Make sure they're being operated within those design limitations, or if you're operating outside those design limitations, then you understand what the implications of that are for reliability and the total cost, the total net present value, if you like, of exceeding those design limitations for your organisation. It might be worthwhile in the short term, longer term may be causing you some issues in terms of reliability and life cycle costs. Then what we need to do is, for those assets that we've decided are critical, and when we're sure they're the right assets for the job, we're sure that we're operating them well, is focus on identifying the underlying causes of unreliability of those systems and address them. So it's not about root cause analysis, in fact it's about root solution analysis. Let's get to the solutions to address those underlying root causes. And bear in mind that some of those root causes are not technical in nature. We're not necessarily talking about modifying the equipment here. It might be changes that are required to the way we operate the equipment, the way we maintain the equipment, maybe our specifications for spare parts and so on and so forth. So we really need to focus on eliminating those causes at source. But the key really in the first instance is to focus on those most critical assets in the first place. So if we focus on those critical assets, there are a number of benefits that we can achieve. We're going to increase potentially throughput with little or no increase in outgoings, in expenditure, little or no additional capital expenditure. We should see reductions in maintenance and operating labour costs. We should see reductions in the amount of spare parts we need, reagent usage, energy costs, a lot of other potential cost savings there. We'll also, depending on the asset we're talking about, we may in fact be able to decommission or park up some assets and while it's still achieving our target throughput level. So again, improving our capital productivity, or if not park them up, at least defer expenditure on additional or replacement assets. In addition, we should be able to see improvements in safety and environmental performance. There's an increasing body of knowledge now that is showing that there is a direct link between plant and equipment reliability and safety performance. DuPont themselves, for example, have identified that the person that is most likely to get hurt within their organisations are maintenance technicians with less than 2 years of experience who are working on a breakdown job, an unplanned job. And when you think about it, when are people most likely to get hurt? When they're likely to cut corners or take additional risks, and they're more likely to do that when they're under pressure to get equipment back to work quickly in a breakdown or an unplanned environment rather than in a planned environment. So it shouldn't really come as any surprise that if we improve plant and equipment reliability, then we also improve safety outcomes for the organisation as well. And so overall we'll reduce the risk for the business. Now, I guess one way of trying to sort of build a bit of a business case for this is to look at our economic value add driver tree, and the writing on this is pretty small, and I don't expect you necessarily to in this presentation I'm certainly not going to explain how the economic value add driver tree works, but let's suffice it to say that economic value add is a key measure that stock market analysts use for determining whether it's a good investment to invest in a particular organisation or not. So and in many respects has a direct linkage to share price, which at the end of the day is what drives a lot of our executives these days, especially if they're being paid in shares or their bonuses are being paid in shares or stocks. But there's a number of elements that go in this tree to make up that economic value add. One of those is sales. Now, if we can improve reliability of our plant, particularly on those bottleneck assets, we should expect we'd be able to get more output out of our plants, and so our sales would go up. At the same time, our variable cost of goods, because we've got more reliable equipment, maintenance costs should go down, our direct operating and maintenance labour goes down, spare parts costs come down. We'd expect to see those direct costs reduce as well. In terms of the value of fixed assets that we need to have to produce a certain amount of output, we'd expect to see that decline somewhat as well. And potentially, because we have reduced risk, better safety performance, better environmental performance, fewer catastrophic production loss events, then we would expect to see that the beta factor for our share, assuming we're a listed company, would decline maybe very slightly, only very slightly, but nevertheless what that should see is that reduction in risk should drive our weighted average cost of capital down. And what that does basically is drives our EVA number up. So if we look at a mining organisation, and I've taken BHP Billiton here just as an example, and I've used figures from their annual report from financial year 2013, and I've had to make clearly some assumptions about the proportion of their costs, their direct costs and so forth. So, it's not an exact analysis here, but nevertheless I'm doing this, I guess, to perhaps illustrate a purpose. If BHP Billiton was to increase its overall equipment effectiveness, in other words, increase the output of its plant by 1%, without having any other impact without even considering potential for reductions in cost, reduction in capital value and so forth, then the model would suggest that BHP Billiton's EVA would increase by 18%. On the other hand, if it was to focus instead on reducing its operating costs, then reducing its operating cost by 1% actually also increases EVA, as you expect, but only by 4.4%. So the key message here is that still within the mining sector, there is bigger bang for buck by focusing on improving uptime, by improving equipment reliability, than there is by focusing on reducing operating costs, and in particular by focusing on reducing headcount and only focusing on the labour cost, the labour productivity side of the equation. As I said before, DuPont had a very strong focus on reliability improvement. They developed that model that was there before. And the results of their work basically over a 10-year period, and the key thing to notice here is it took them 10 years to achieve the full results, and that in itself creates a bit of a challenge for most large organisations, because 10 years is definitely much longer than the average tenure of a COO or a CEO or a senior manager. And so one of the challenges, how do we maintain, I guess, the constancy of purpose and the constancy of direction to drive an initiative like this forward? And DuPont were very fortunate to have, I guess, a key team on their executive team that were there for that full 10-year period that drove this improvement. So it's not a short-term fix, it's clearly a longer-term fix, although you do certainly see some improvements quite quickly, as this chart shows. But essentially, over that 10-year period, the improvement that DuPont Chemicals and Specialties saw was a $700 million improvement in the cost side of their equation, and potentially even more in terms of sales revenue and profits. And they're in mid-1990s dollars, so fast forward 20 years, and clearly the size of the prize is potentially a lot greater than that. So in other words, it's a target worth shooting for, and I think it's a comparatively simple goal, is to focus on improving the reliability of your plant and your production processes. Give focus on key assets. Make sure it's the right equipment, make sure it's being operated well, and then focus then on a continuous improvement process to progressively eliminate those causes of unreliability. So what skills do you need to make this work? I'd say there's 3 or 4 key skills that are involved. One is business analysis skills. There needs to be, I guess, someone within your organisation, or someone external to your organisation who can help you identify what those critical assets in critical asset systems are that are going to give you biggest bang for buck, and again can draw the linkage between equipment reliability or process reliability and the bottom line of the organisation as a whole, rather than just a mine site, if the mine site is part of a bigger network of mine, port, rail and so on and so forth. You need technical skills, because you need people who can understand the technical levers that can be pulled to improve the process performance, process reliability, equipment reliability and so forth. You need business improvement and change management skills, because a lot of what we're talking about here is less about changing the equipment, it's more about changing the things people do to the equipment. So it's actually about, I guess, changing work practices and processes. And when we were asking people to change, then we need those strong people management, business improvement type skills. And finally, we need leadership. And that's probably the one thing that you can't outsource. The others you could potentially outsource to some extent. but leadership you cannot outsource. Someone within your organisation, and preferably at a senior level, needs to take the bull by the horns and say, this is the way we're going. We are going to focus on reliability improvement. The path is simple, the path is clear. The number one priority is to improve our process and our equipment reliability. And if we do that, then the bottom line benefits will result. So that's basically what I had to talk about today. Thanks for the opportunity. I hope you've managed to survive this far through the presentation. My contact details are on the screen here. If you've got anything that you'd like to discuss further, visit us at our website, www.assetivity.com.au. Send me an email, drop us a phone call, give us a text, tweet us, whatever. Happy to engage in some discussion around this particular point. Thank you once again.